I figured I'd just walk through. So dividend investing, this has been an important theme for us for, I guess, about 12 years. Um, when we
Probably
started to
more.
do our probably even more. I mean, just when we started to do our dividend growth research. And
Time flies when you're talking dividends, right?
yeah, well, where it really started was, in the wake of the 2008 financial crisis. We wanted to look at some names where, one, I mean, you were getting zero return from the bond market or the fixed income market. People needed income, but we wanted to also get some stability and mix into the portfolio. So dividend research has been, a focus of ours, and there's some very good reasons for that. So just to kind of make sure everybody's on the same page, most people know what dividends are. These are income payments made by corporations to their shareholders. Generally, they're made quarterly or monthly, and they differ from bonds in that they're paid at the discretion of the company. So every month or every quarter, the company is going to make the decision whether or not to pay the dividend. Whereas a bond is the coupon payment, the interest payment. That's an obligation of the issuer over the term of the bond. So that's one of the big differences between a dividend payer and a bond. But where our focus is, as I said, we're growth investors. So our focus is on what are called dividend growth stocks. So these are companies, they're growing businesses, they pay a dividend, but they're investing enough capital back into the business that they can continue to grow and they can increase their dividend over time. So that's really what we're looking for, as opposed to just that traditional low growth dividend model where, yeah, you're getting a dividend, but you're not getting much else. So there are a lot of good reasons why people should invest in dividend stocks. So one is the cash flow. A lot of people need the cash flow. Sometimes they use it as income for their living expenses. Sometimes they reinvest it, but getting that cash flow is good. But then the growing dividend as well, particularly in an environment like we're in right now, can help to offset the impact of inflation. So if you're getting a coupon payment or a dividend payment, that maybe equates to a 5% yield today, but we're in an inflationary environment for many years. If that dividend payment does not grow, then your real purchasing power from those dividends declines actually. So the growing dividend could help to offset that. Now, a lot of people think that dividend payers are just boring companies. Some people even say avoid dividend stocks completely. That's really bad advice. Even if you don't care about the dividend themselves, some of the most stable, best managed companies in the world do pay dividends. So if you, as a rule, ignore dividend companies, you're ignoring some of the best companies to invest on. And then the last point here, and this is something that I'm going to get into in the next couple slides, is that dividend growth stocks on average, they substantially outperform non-dividend payers, and they do that at a lower level of risk. So let's take a look at some of that data. This is data that is put together every year from RBC Capital Markets. And what they do is they, from 1986 to current, which the most current year, of course, being 2021 that we finished, they track the performance of dividend growers, dividend payers, and then non-dividend companies, so companies that don't pay dividends. And this is for the TSX, so up here in Canada. And what they found is consistently every time I look at this research, dividend growers substantially outperform every other category, just on an average return basis, right? So over this period of time, dividend growers are generated an average annual return of 11.2%. That would be including the dividend. And you compare that to the market average of 6.5%. So significant improvement over the market average, but then compare that to non-dividend payers, companies that don't pay dividends, 1.4%. So almost, just an absolutely substantial outperformance between the two groups. Now, of course, these are averages. When you go into the different categories, you're going to find some dividend growers don't perform as well. Some non-payers perform extremely well. But as an average, you're getting a far higher return by investing in dividend growth stocks than you are by investing in any of these other categories, especially companies that don't pay dividends. But wait, there's more. Risk. So investing is not just about return. It's also about managing risk. So RBC also tracks the volatility, annualized volatility of these categories over the same time period. And once again, dividend growers always lead the pack in terms of, in this case, lower volatility. So volatility just being a measure of risk, how widely does a stock price fluctuate? Dividend growers annualized 13.2% volatility, less than the market average, a little bit less than the market average, but way less than non-dividend pairs that are almost up there at about 25%. So almost half the risk, right? So many times the return on average, little over half the risk. I mean, it really is a conclusion unto itself. I mean, if you don't have dividend growth stocks as a key part of your portfolio, we believe you're setting yourself up at a systemic disadvantage. So this is why we think that every investor should have some dividend stocks in their portfolio, some dividend growers. It doesn't necessarily have to be all of your portfolio. It doesn't even have to be the majority of your portfolio. The composition is going to change a lot. It's going to depend on the individual, the risk tolerance, a number of different things. But the way that we see it, the dividend grow stocks, as long as you're selecting great companies, which is what we look to do, they form the foundation of your portfolio, right? So you're building your portfolio on the strong foundation, and then you're adding layers of risk to augment that return. And that can be small caps, that can be some of these exciting technology companies, maybe even a little bit of commodities as well. But it's generating the right mix of these different types of stocks, which include dividend growers, that set a portfolio up for success in the long term.
Awesome. One thing that I love to stress too is just, the effective yield, as how it grows when you purchase a stock, say several years back, and that company continues to grow the dividend, that effective yield that you get to, put in your pocket. Like I know I've said this on the podcast before, but Brookfield Infrastructure, I believe if you bought it in 2011, you're getting an effective yield of over 20% on that initial capital every year that you put in to that stock. Even just with my own portfolio, Dynacor just ended up increasing their dividend again recently. And, I think my effective yield is now over 7%. So, I'm getting 7% on that initial capital that I invested in that stock every single year now. I just think it's great. It's great to see a company growing their dividend, and, slowly that effective yield grows as you hold the position.
Yeah, absolutely. It's a great point.
Yeah, for sure. And like you said, on Dynacor, they originally had no dividend when we recommended it, and then it instituted the dividend. And from like some of the the buy prices that we've had on it, it's over 7% effective dividend rate, and we expect it to continue to increase that. It really that dividend kind of compounds to higher levels over time for you.
And it's a monthly dividend too, so it pays for my coffee every month, which is kind of nice. So
all right. At least you don't have to pay for it yourself, right? One other thing that I should mention as well, just for information, we talked about this on the interview on Money Talks as well, is that we're in the process of putting together our 2023 Canadian Dividend All-Star Report. So a lot of really exciting companies that we're looking at through there. And this is starting off with a list of about 350 dividend paying stocks in Canada. So this is when you strip out the ETFs, the funds, some of the split corps, that's basically what you got. You have a universe of 350 companies in Canada that are paying dividends, and we go through every single one, right? So we have our current list of recommendations from our income research. So we obviously go through all of those and provide updates in the report, but we go through every other company as well. So that's potentially new recommendations. There's a couple that we're very close on. Actually, we all four just had a really interesting call yesterday with the company back east, the small cap dividend pair. So we're looking to add a few to our current list, and then there's also going to be about a 10 to 15 stock monitor list. So companies that aren't quite ready for our recommendation, but where we see a high probability of a recommendation over the next 1 to 2 quarters.